And what I'm saying is that those kind of central banking based monolithic systems are going to lose, and they're going to be replaced with decentralized systems that put, more of the power in the hands of the people as opposed to governments.
Alrighty, everybody, what is going on? Welcome back to another CYPRX video breakdown. Today's video is going to be one that you are not going to want to miss. We're going to be listening to industry-leading experts from the Stellar Development Foundation, from Algorand, and we're going to be tapping into some insights from some large financial institutions that are actually building out solutions in the DeFi ecosystem, utilizing these public blockchains, telling you guys that holding cash is the wrong answer, and not having any exposure to the digital asset ecosystem puts yourself at a higher risk than actually having exposure in the crypto ecosystem, and how now we are entering into an era where we, as the individual holder of these digital assets, can utilize them in the DeFi ecosystem to generate yield, to make passive income, and to become our own bank. So let's jump into today's video breakdown. I have some panel discussions to play for you guys, some video clips, and we're going to be going over some documentation. If you all enjoy these deep dives, showing you all the proof is in the pudding that this transformation is happening at a very rapid pace, and you all should be paying attention. Do me a favor, smash that thumbs up button and subscribe. As always, bringing you all some of the realest research and information. So we're going to start here, where the banks are physically telling you all that holding cash is not a good idea. This is a document directly from Citi, and it talks about at the very top, with the global economy potentially set for further upside, we make the case for portfolios that are positioned for potential growth, but are prepared for the risks of a disordant world. Then down here in the key takeaways, it says, we believe in continued global growth and rising profits in 2025, and we make the case for broadening portfolio horizons with the potential in several different asset classes. Now, in this document, it mentions crypto over 30 different times. It says the global market for digital assets continues to expand, and back in November 2024, the combined capitalization of cryptocurrencies alone reached an estimated $3.2 trillion. And then right here, it says, while valuations have risen since 2022's lows, we see potential for opportunities across different asset classes globally. We believe this calls for a broadening of portfolio horizons, especially for many investors whose allocations are overly concentrated. We also expect that holding a lot of cash will remain unrewarding. So directly in their documents, they're telling you guys that holding cash is not a good idea. And if we come over here, I played a video clip for you guys of an individual representative from the Stellar Development Foundation. This is Tom Weller, Chief Product Officer at SDF.
Yeah, I think, the more yield-bearing stablecoins we're going to see, the more competition there's going to be around, how much yield and how distributed to the users. And so I think this place where we're at right now, where there are a bunch of stablecoins and functionally they're doing the exact same thing, I don't think that's going to stay for long. And, people are realizing, I made this equivalent for like checking account earlier. If you're just holding dollars and not getting yield on them, you're effectively losing money. Right. So if you want to be a participant in the on-chain economy, you want to have a way to park your money in a way that generates yield. Yield-bearing stable coins are the way to do that. And there's going to be a lot of competition with that space.
So I'm here in an attempt just to show you all that they are for a fact talking about this on stage, not only in their documents telling you guys that holding cash is a bad idea, but that if you're not generating yield on your idle capital or your cash, if you are holding any, then you're also losing money. And this is coming directly from market participants, from organizations whom you know and most likely have heard about, probably even hold some XLM in your portfolio, right? Considering that we are entering into an era where we're going to be able to utilize our XLM in the DeFi ecosystem to generate passive rewards. This gentleman here on stage, I don't remember specifically from what organization he stems from, but this is a digital asset forum that took place this year, and it talks about macro trends and predictions for 2025. This video breakdown has 35 views, and listen to him mention that generating yield is a human right. Take a second and listen.
Solving the need for the right mediums in native digital form to exchange value is if we don't solve for that, all the capital can come in that we were just talking about, and it still can't make its way in, right? Like, so it's one of those primitives that you need, and it's like yield. yield. There was this panel I was on years ago, and we kind of joked at the end that yield is a human right. You know, like we should all have access to yield if we want it. And as much as that sounds a bit ridiculous, it's kind of true. Like it shouldn't be that because I've got more money than you, I can get a better yield, right? It should just be democratized. And that's what we're all trying to solve for if you really break it down.
And that's what we're all trying to solve for if you really break it down. Again, showing you all proof that they are for a fact building out a new financial infrastructure, incorporating traditional finance with DeFi rails, where we, as the everyday average retail investor, are going to go from being able to earn, you know, in a checkings account 0.05% on our idle capital to earning 9 to even sometimes in some cases 17% on idle capital. But then at the same time, taking these digital assets that have utility, for example, XLM, XRP, Bitcoin, even nowadays, to take that and go and deploy it in the DeFi ecosystem and generate passive rewards, not only with our stable coins, but also with our digital assets. This is massive, right? And so many people are fading this information. To continue down the rabbit hole, I set a friendly reminder to lock in. This is coming directly from a Securitized post. It says, for many financial advisors, crypto is no longer a question of if, but how. And then it says, with this outlook, ignoring crypto altogether not only risks underperformance over time, it raises the question of whether clients who aren't allocated to the asset class are truly being served in a future-focused way. Then here it talks about recent data from the 2025 Institutional Digital Asset Investor Survey. According to this study, 59% of institutional investors plan to allocate over 5% of their assets under management to the cryptocurrency ecosystem, and nearly 70% view crypto as the biggest opportunity to generate attractive risk-adjusted returns. Almost 80% expect the asset class to rise in value. And remember, I showed you guys starting this off a fundamental piece from Citi where it talks about holding cash will remain unrewarding, and they talk about expanding your horizon into several different asset classes. And in this document mentioned crypto over 30 times. I'm physically showing you guys that they're telling you all this stuff is going to be the future. Now, to solidify this, not only utilizing documents, but actually listening to experts on stage from SEC registered companies, here is a lady sitting next to Robbie Mitchnick from BlackRock telling the audience that having 0% allocated to this digital asset ecosystem is the wrong answer, which just goes hand in hand with the document that I just showed you guys.
What is the appropriate level of allocation that institutional investors should consider when they're looking at bringing digital assets into a portfolio?
So what I'd like to say is that zero allocation to the space is the wrong answer. More than 2 to 10%, 10% if you can't stand it, if you're not all in on the space, is also the wrong answer. This is a nascent asset class. It is risky. But what has us all excited about the space is the asymmetry of risk reward.
Not having anything allocated to this digital asset ecosystem is the wrong answer. To continue down the rabbit hole, I mentioned the masses are coming. Earning yield on digital assets will be the new normal, and now is the time to lock in. To go from the mindset of just hodling in your cold storage wallet to hodl and earn. Understanding that through the utilization of DeFi, different protocols, different DEXs, different yield aggregation platforms, you can actually earn on your idle digital assets that are sitting in your cold storage wallet by connecting your cold storage wallet to these different platforms. You don't have to risk security measures that you're already taking to generate passive rewards. There are integrations that have happened with Ledger, with the Decent Wallet, with Treasure, all these cold storage wallets where you can start to generate passive rewards directly in your cold storage wallets, which is massive. So we need to transition our mindsets from prior years, like before 2023, where everybody is so fixated on price appreciation and hodl, hodl, hodl. Now it should go to price appreciation, hodl, and earn passive rewards on your digital assets. I said earning yield is the new sexy. Wake your dormant assets up, people. Put your liquidity to work. The banks do. Now, so can we, the people. And they're telling you guys this on stage. Take a second here and listen.
Holding them, they were walled off from it. I mean, it was basically just like a no-go zone. And that is changing. I think, within 18 months, we're going to see retail's interactions with this stuff go from basically non-existent to significant. And we still haven't seen it yet, but like, this is one of these things where like, we're going to see it in the short to medium term. This is not, something we're going to have to wait a very long time for.
And some food for thought, things that we've seen on the Stellar ecosystem that I think are not ready yet, but are interesting gray zones to explore, not from a regulatory, well, maybe from a regulatory perspective as well, but gray zone in the sense that it's still early days, is using yield assets as trading pairs or staking assets on DeFi. So we sometimes use different terminology for almost the exact same use case, because there's a lot of like yield farming or staking, which is just a way for you to hold something that is yielding interest and also trade in the same on the same asset, and that's margin trading or collateralization, just put it in different terms. But you're stuck with other risks, right? Like the native asset risk or the node risk or whatever. So if there is a situation where a money market fund could be put as liquidity on Uniswap or used as a collateral for a DAO protocol, you're actually now holding a very secure asset that's yielding you 5-4%, whatever the underlying asset is, and you're still doing whatever funny things you were doing on DeFi before. So that's one use case. And the other one,
right? So he's talking about generating yield with your idle digital assets in a nutshell. Now we're going to head over here to this gentleman. His name is Bill Barheit. Hopefully I'm pronouncing it correctly. And listen to what he says about the future of the banking system, right? How he talks about what is being integrated and what's going to be possible in the near future. Take a second here and listen.
And macro, just like overall increasing interest in crypto. Do you see a world where blockchain becomes the underlying rails of finance and DeFi becomes the backbone of it, like similar to what you're doing?
Yeah.
Like you're interfacing with investors but using DeFi in the back end. Do you see that like being the norm, or will it continue to be still niche?
Yeah, I think what we call DeFi banking today will soon just be banking, and all banking systems will be based upon DeFi-like rails. Just like we talked about earlier, that stock trading should be done based upon tokens, right? And governance tokens should accrue dividends. I think banks themselves should be using DeFi rails that use open marketplaces for lending and yield, and they operate 24/7, and that's how it's going to work. Meaning it won't be called DeFi; it'll just be called banking. Right? You don't, I mean, most people have no idea how the inner workings of a money market or a repo system work. No idea. They don't even know what the words mean. So, but we just call it banks. And what I'm saying is that those kind of central banking based monolithic systems are going to lose, and they're going to be replaced with decentralized systems that put, more of the power in the hands of the people as opposed to governments at scale. And maybe some of these banks don't exist today.
So he specifically mentions putting the power of the banks back in the hands of the people. And that's what here at CYPRX, we're trying to get everyone to understand, is that right now we have an equal opportunity that the banks have had for literally years on years on years to, generate yield on assets. And now for the first time ever, we have this equal opportunity. And because people are fearful, because people lack education, they're sleeping on this. And I'm physically trying to show you guys that the banks are for a fact going to be utilizing this. So let me show you guys more proof. If you all are enjoying this video dive, do me a favor, smash that thumbs up button and subscribe. So this is the document titled Europe Driving into Crypto. And if we come over here, looking at some key highlights from the statistics that were taken from this survey, it says with European financial institutions seeing crypto becoming more relevant in the future, a majority see crypto as a relevant and distinct asset class. Keep in mind the document that we showed you all at the beginning from Citi, where they said, cash, holding it is going to be unrewarding, and you should be making investments into alternative asset classes right now. And I've shown you guys multiple different documents now from Securitize and now this one, telling you all that crypto is going to be a preferred asset class from an institutional perspective. It says financial institutions have a stronger conviction that crypto is a legitimate and respectable asset class than private and business investors. Additionally, European financial institutions anticipate a substantial increase in the relevance of crypto over the next 3 years, with 83% strongly agreeing with this forward-looking perspective. The two types of banks that are most skeptical about the future relevance of crypto are regional banks and universal banks. However, despite their cautious stance, the majority of these banks still hold a positive outlook on crypto. Here are those statistics. Out of all the individuals surveyed or the institutions surveyed from the UK, from the Eurozone, from multiple different jurisdictions, each of them, over 50%, agreed that crypto will become more relevant in the next 3 years, which is why you all should be tapped in and paying attention to detail. Now take a second and listen to the Algorand CEO, go on to talk about yield generation and how financial institutions will not just want their capital sitting idle and dormant, collecting no yield. And the reason why I'm showing you all this is because if we are seeing statistics that over the next 3 years, institutional investors think that crypto is going to become a relevant asset class and they're going to want to participate and embed themselves into crypto and digital assets, well, then boom, that pieces it all together. They are going to want to be generating yield. They're not just going to want to sit there and hope for price appreciation. They're going to want to put their dormant assets to work. Take a second here and listen.
It's pretty interesting. You know, so the industry keeps coming up with these new innovations, but I will say that what I think will happen is that traditional finance, every player will get tired and will no longer tolerate that their money is just sitting there doing nothing. This will not be acceptable anymore. You know, when you hold collateral with your bank, and your bank is of course earning money on your collateral, but you're not earning money on your collateral, your initial margin, your variation margin, all of that, putting the ability to embed yield and with quick transferability, that combination is incredibly potent. And so I'll give you just one kind of far out example of that is I will take my Aberdeen money market fund, which is yield bearing, and I will go to your coffee shop and I will buy a cup of coffee with my tiniest sliver of my Aberdeen money market fund, and I will be earning yield until I hand this to you, at which point you will be earning yield on this little tiny piece. So, you know, cash is an asset, apartment building is an asset, they're all assets. This continuum will get just completely blurred and more liquid, I think. That's my futurist.
All these perspectives are coming from organizations whom you most likely know if you've been a follower of us here at CYPRX. We have people from the Stellar Development Foundation talking about yield generation. We got the freaking CEO of Algorand Foundation talking about yield generation and the future of the financial ecosystem and how you're going to be able to earn yield up until the very last moment that you spend. Now is the time to start to study this stuff, right? Now is the time to start to understand how to get your digital assets working for you. And you don't have to go out and expose yourself or your crypto to the DeFi ecosystem right now to learn. But watch a video, watch a panel discussion, read documents, join a mentorship program like the one that we offer here at the CYPRX Wealth 28 Club to go through the DeFi University and understand how these things work. So that way, when you're comfortable, you can start to earn, you can start to generate passive rewards, and you can actually put the power of the banks back in the palm of your hand with your mobile device and an internet connection. With that being said, take all of this into accountability. If you guys want to tap into our DeFi University, you want to see how we're getting our digital assets to work for us here at CYPRX, head over to CYPRXtrading.com. We'd love to have you on the team. And if not, make sure that you tap into all the free content that we deliver for you all on the Yield playlist in the CYPRX YouTube. Head over to the X profile, follow the CYPRX researchers and myself on X, constantly delivering you guys documents and updated information. With that being said, I'll see you all in the next video breakdown.